This video is for educational purposes only. We are not financial advisors. Past performance is not necessarily indicative of future results. Please note that we do not offer technical support. While we routinely maintain our website, videos, and member tools to ensure proper functionality, any issues related to third-party platforms or software, including interactive brokers, YouTube, Microsoft Excel, Adobe PDF, and others, should be directed to the respective service providers. Sell a put spread on the interactive brokers trading platform. Before starting this video, you should already be familiar with the structure of our trading instructions, the interactive brokers option trader interface, how to enter the underlying asset symbol, select the option's expiration date and strike price, and how to execute a trade. All these details can be found in the video shown on screen. In addition, the sell put spread and sell call spread are two mirror image-like strategies. Therefore, we strongly recommend rewatching the video shown on screen and fully understanding its details and key points. This video will only provide a quick review of the steps for executing a sell put spread. Let's get started. If you receive this trade instruction, you'll need to sell an XSP put with a strike price of $X expiring on June 6, 2025, and simultaneously buy an XSP put with the same expiration date but a strike price of $Y. According to the star-marked hint, the delta of the $X strike is around -0.34, and $Y is 1 point lower than $X. The reward-to-risk ratio for this spread must be greater than 0.33, and the higher, the better. In Option Trader, select the Strategy Builder tab, then choose the correct underlying symbol and expiration date. The put with a strike price of 580 has a delta of -0.343, which is the closest match to the trade instruction. So, $X should be set to 580. Back in the Giga Certainty Position Manager, the second set of tools in the Cash Flow worksheet is specifically designed to simulate a sell put spread. Here, enter the correct underlying symbol and expiration date. Enter 580, i.e., $X, in the cell shown on the screen. Enter 579, i.e., $Y, which is 1 point lower than $X, in the cell below. Enter -1 in the cell shown on the screen, the cell below will automatically calculate to 1. The worksheet calculates that, at the current market price, the reward-to-risk ratio for this option spread is 0.36, and the risk exposure per contract is $73.50. In Option Trader, select to sell the 580 put and buy the 579 put. The price quoted by interactive brokers is 27 cents credit per unit of the spread. Back in the Giga Certainty Position Manager, enter 0.27 in the cell shown on the screen. The worksheet calculates that, at this selling price, the reward-to-risk ratio is 0.37, which is above the trade instruction requirement. So we'll use 27 cents as our minimum selling price for now. Now let's begin the actual trade. In Option Trader, the current lowest ask price for this option spread is 38 cents. We'll start by placing a slightly lower ask price at 36 cents, then gradually lower it if necessary. If the order still doesn't fill at 27 cents, we'll cancel it and recalculate a selling price that meets the trade instruction criteria. Let's go back to the Giga Certainty Position Manager and lower our selling price in the cell shown on the screen. When the selling price is set to 25 cents, the reward-to-risk ratio drops to 0.33, which is the minimum required by the trade instruction. We'll start testing for execution in Option Trader at 26 cents. If the order still doesn't fill at 25 cents, we should cancel the current order and begin again by identifying a new $X, then repeat the process outlined in this video.